Open with a strong warning. The next market crash may not begin inside a bank. It may begin with energy, not with a failed mortgage lender, not with a collapsing hedge fund, not with a Wall Street trading desk, but with electricity, oil, gas, power grids, data centers, shipping routes, and the rising cost of keeping the modern economy alive. Most people still think energy is just another sector of the market. But that is the dangerous mistake. Energy is not one part of the economy. Energy is the foundation underneath every part of the economy. Every factory, every server, every truck, every supermarket, every hospital, every bank, every payment system, every AI model, every home, and every military supply chain depends on cheap, reliable energy. The opening should make the viewer feel that the real trigger is hiding in plain sight. Key line: the last crisis started with bad loans. The next one may start with the cost of keeping the lights on. Main emotional effect: curiosity and unease. Now step back and explain the old economic model. For decades, the global economy was built on one silent assumption: energy would stay cheap enough. Cheap oil moved goods across oceans. Cheap gas powered factories. Cheap electricity kept cities running. Cheap diesel fed supply chains. Cheap energy made globalization possible. Consumers did not see this directly. They saw low prices, fast delivery, full shelves, rising markets, and expanding companies. But behind all of it was the hidden subsidy of cheap energy. When energy was cheap, companies could protect margins. Governments could hide inflation. Central banks could keep the financial system stable. Consumers could spend. Markets could rise. This chapter should show that cheap energy was not just a convenience. It was the invisible engine of the modern economy. Key line: globalization was not powered by trade agreements. It was powered by cheap fuel. Main emotional effect: scale and clarity. Now introduce the shift. The old assumption is breaking. Energy demand is rising at the same time the system is becoming more fragile. AI data centers need enormous electricity. Electric vehicles increase pressure on power grids. Factories are being reshored and duplicated. Wars threaten oil and gas routes. Climate shocks damage infrastructure. Aging grids require massive investment. Energy transitions require minerals, capital, and time. This creates a trap. The world wants more energy, cleaner energy, more secure energy, more digital energy, more industrial energy, but it wants all of this while keeping prices low. That may be impossible. Use competitor-style escalation. First, electricity demand rises. Then, grids become strained. Then, energy prices climb. Then, companies lose margins. Then, inflation returns. Then, central banks cannot cut rates. Then, markets realize the old rescue playbook no longer works. Key line: the world is trying to build the future on an energy system that was already under stress. Main emotional effect: hidden pressure building. Now connect the topic to a highly popular global theme: AI. AI is not just software. It is physical infrastructure. Behind every AI model are chips, cooling systems, data centers, transmission lines, power contracts, backup generators, water use, and massive electricity demand. Wall Street prices AI like a digital miracle. But the miracle has an energy bill. This chapter should create a strong twist. The AI boom may not collapse because the technology fails. It may collapse because the infrastructure becomes too expensive. If power prices rise, data center costs rise. If grid capacity is limited, expansion slows. If chips need more electricity, margins shrink. If companies spend billions on AI infrastructure before profits arrive, investors start asking dangerous questions. This is where the energy story becomes a market story. AI stocks are priced for unlimited growth. But unlimited growth requires unlimited power, and unlimited power does not exist. Key line: AI may be digital, but its cost is physical. Main emotional effect: surprise and tension. Now show how energy becomes a market crash. Energy shocks do not stay inside energy markets. They spread. Oil rises, transportation costs rise. Gas rises, factory costs rise. Electricity rises, data center costs rise. Diesel rises, food prices rise. Heating costs rise, household spending falls. Utility bills rise, consumers cut back. Corporate margins shrink, inflation returns. Then comes the real danger. Central banks lose control of the rescue mechanism. In a normal recession, central banks can cut rates. In a financial panic, they can inject liquidity. In a banking crisis, governments can provide guarantees. But if the crisis is driven by energy inflation, cutting rates may make inflation worse. This is the trap. Markets expect rescue, but the rescue may be blocked. Use escalation. Energy prices rise, inflation returns. Bond yields climb, consumers weaken, corporate profits fall, central banks hesitate. Markets panic because the old playbook no longer works. Key line: the market is addicted to rescue. But an energy-driven inflation shock is the kind of crisis central banks cannot easily print away. Main emotional effect: inevitability. The final chapter should deliver the big twist. The next market crash may not look like 2008. It may not begin with banks collapsing on television. It may not begin with traders shouting on the floor. It may not begin with one famous company failing. It may begin quietly, with electricity prices rising, with factories delaying expansion, with data centers fighting for power, with utilities warning about grid stress, with consumers cutting spending, with inflation refusing to die, with central banks trapped, with investors realizing that the entire market was priced for cheap energy that no longer exists. This is the final warning. Modern markets are not just financial systems. They are energy systems wearing financial clothing. Every stock valuation, every AI forecast, every supply chain, every government budget, every consumer economy depends on the same fragile assumption. The power will be there. Cheap enough, reliable enough, scalable enough. But what happens when that assumption breaks? End with a strong closing line. The next crash may not start when a bank runs out of money. It may start when the economy runs out of cheap power. Because before markets collapse, the energy that supports them begins to crack. Main emotional effect: serious, global, memorable.